We go, Mr. 𝗘𝗀𝗁𝗂. Welcome to the show.
Thanks for having me.
What it is you do and what's your background?
Yeah, so I'll do the quick background, Cliff Notes version. I grew up in Toledo, Ohio, got my undergrad from the University of Toledo in finance. Then I moved to Cleveland, got my master's degree from Case Western Reserve. And while I was doing that, I spent 5 years as a commercial lender. And then when I graduated, got my master's degree, I decided it was time for me to be a CPA. So I went to work for Deloitte. If you don't know Deloitte, they're one of the big firms. Spent 7 years there. Really had a great time. My daughter was just born, and what happened to me is I was doing her 3 a.m. feeding. And if you're a father, you know, with a daughter, you know that's a really cool time. And father-daughter bond is not something that you take lightly. It's really cool. Problem was 3 o'clock in the morning, that's my time with my daughter, and it just started to frustrate me. I said, this isn't cool. I mean, this is not what I wanted for my life, right? I did everything right. I had a great job working for the big firms. And so it was at that point I said, I got to fix this because I don't want to miss my daughter's basketball games. I don't want to miss my son's baseball games. So I went headlong into real estate. Back then, I didn't have much in terms of ability to learn, right? There were no podcasts, there were no courses, nothing like that existed. Took me a year and a half to figure it out. During that time, I bought 3 buildings and sold them after 3 years, made $500,000. And I realized, wait a minute, I just made more money on the side in real estate than I did the whole time I was working at Deloitte at the time. I hadn't been there the full 7 years yet. So I just said, you know what, this is what I need to do. And fast forward, you know, obviously I have been very, very successful. We have made millions and millions of dollars for us and our investors. And I'm happy to report I missed almost no basketball or baseball games. So we did the right thing. Yeah, making money in any business is about the numbers, executing a business plan, all of that sort of stuff, and really paying attention to the details. So it is, I mean, when you're a CPA, you learn to do that. When you're a commercial lender, you tend to do that, right? So it just, you know, not most people that get into my business didn't come from commercial lending and a CPA background, which gave me a huge advantage because I understood the business world a little differently than everybody else. The other thing I would say is, you know, for me, real estate's not passive because I'm running the business, but we raise money and people invest with us all the time. They're passive. For them, they literally do nothing except, you know, look online and see another deposit into their bank account. So there is the right way to become passive. It's just so many people approach this business thinking they can do what we do, and they view it for some reason as passive, and there's nothing passive about it. Obviously, real estate's a capital-intensive business, right? Requires a lot of capital, debt. You got to use debt wisely. You got to be smart about it. You can't abuse it. You got to understand how lenders think, right? Basically, there's 2 people in every deal, a lender and the equity guy, right? Or gal. And so it really, really helps if the lender is going to be 65% of the deal to understand them, really understand them, and what makes them think, why they need what they need, why they care about what they care about. And so spending 5 years as a commercial lender really, really helped. Now, oddly enough, I didn't really do much real estate lending when I was lending, but you know, the concepts of lending are still the same, right? You know, your primary source of cash flow or repayment, your secondary, all that stuff still matters. And it just really gave me probably a very unique perspective on risk management, because eventually banks see deals go bad, right? I mean, nobody thinks their deal is going to go bad when they go into it, but banks know, because that's just what happens. You know, not every deal makes it. And so how should you how do you protect yourself against that? How do you mitigate that risk? So, I mean, it's just been massively helpful in helping me mitigate all the risks of operating our business every single day. It's not the low cash flow distributions you get. Those are baby. The big one is when that asset appreciates. If you think about, if you got a 100-unit property, and I know you're probably not going to start out at 100 units, but if you had a 100-unit property and you raise rents on average $100 a month, so that's what, $10,000 a month of new income. Most of that falls all the way to the bottom line, because just because you charge a guy $100 doesn't mean your whole expense structure changed, right? So there's 10 grand a month times 12 is 120 grand a month or a year. And you think, man, that's a lot of new cash, but that's not the real value. The real value is when you divide that by the cap rate, let's pretend they get 6 or 5%, you just created $2.4 million of value. That's the payday in this business. And that's why I want you to understand the numbers. Everybody has to understand the numbers so that you can make sure that you can generate that extra $100. Because if you do, you're going to make a killing. Right now, yes, people left, insurers left the market, left the state for a couple of reasons. One was just the laws make it so easy to sue somebody else. And I mean, it's just that part of it's not very fun. And then there's this risk of hurricanes and things like that and some significant losses. And then they had some other law that allowed, if you had some roof damage, you could assign your claim to the roofer, and then the insurance companies had to deal with the roofer directly, and it just really got out of hand. So they're making changes to fix that. But here's what happens. Insurance price, yeah, it's been brutal. I mean, insurance rates have gone so high that these insurers now are just printing money because they raise their premiums and they raise deductibles. And that's a bummer for us, right? We'll get through it. But what happens now is they're making so much money, it will draw other insurers back into the market because it's just so ridiculously profitable. And the cycle will start to turn and pricing will come down. They call it capacity, right? There's just no place for some people to go to get insurance. That capacity will come back when, for example, we're just coming off of pretty low storm season. You know, we just need a couple of those. These guys are recovering very, very quickly. And so I know that I believe we're pretty much at the top of the insurance crisis. And most of the people that we talk with in the insurance business believe that it's starting to turn, and it will. So if I could buy an asset now at this insurance cost, at this interest rate, and still cash flow, I'm in.
Can you tell us a little bit about the cost per door, cost per unit per year for insurance that you're seeing in Florida right now?
Yeah, we have properties that are at $1,100 a unit to $2,100 a unit.
Holy smokes, that's a lot. Holy cow. But it doesn't, whether it triggers a chemical emotion in my head or not, it doesn't matter. It's about what that spreadsheet says. So
yeah.
Wow, $1,100 to $2,100.
Just depend. Now in Florida, it depends on how close you are to the coast,
right?
How old the property is, what kind of construction it is. I mean, you know, this isn't a random thing, right? If you're in the middle of the state with, you know, newer product, I mean, you're going to be closer to $1,100-$1,200 a door.
Wow. If
you're, you know, a mile and a half from the coast and your wood frame, well, I don't even know. That's probably going to be $3,000 a door. I don't know. I mean, you know, that they just, you know, they don't like playing roulette, just like you shouldn't.
Wow.
So if we have properties that are kind of close to the coast, but they're block construction. I mean, they're sturdy as the day is long. Most of the deals that we find are through brokers. Mm-hmm. So we used to syndicate, right? So that's, you go find the deal, lock it up, and then go out and raise the money. Well, in a place like Florida, you're one of 20 syndicators bidding on the same deal, right? How do you differentiate yourself? So a few years ago, I said, you know what? We need to go raise the money first and then go find the deal. It's called a blind pool fund is what it's called. I don't want to get technical, but you're raising the money first. Well, we've done that. The last fund, we raised $16.5 million. The first deal never saw the market because brokers love buyers with money and sellers love buyers with money because their certainty of close is so much higher. And the second and third deal that we put in that fund never even saw the market. I'm sorry, no, that's not true. We were the second in line. We were not the highest bidders on either of those two deals. And why do we get them? Because we already raised the money. We differentiated ourselves by raising the money first.